Let's talk about India's foreign exchange reserves today. The Reserve Bank of India has stated that India's forex reserves remains adequate to cushion any external shocks, even as heavy as foreign investors' outflow of $12.1 billion in March 2026 alone. It has weakened the rupee to record lows. Although reserves stand at a robust $710 billion, close to the recent peak of $728 billion in our country. The headline figure needs closer examination to assess the true strengths. Now, this is what our Reserve Bank of India has said. Now, in order to understand this entire issue completely, we need to first understand what are the components of India's foreign exchange reserves. So, India's foreign exchange reserves, it's comprising of four key elements. First is the foreign currency assets. Second is the gold holdings. Third is the special drawing rights (SDR), and fourth is the reserve transposition with the IMF, that is International Monetary Fund. Now, when we talk about the minor components, which is having limited immediate use, we talk about the special drawing rights, which is valued at around $18.7 billion. It is based on the basket of global currencies and it serves as a buffer that can be exchanged during crisis. Now, let's talk about IMF reserve transposition. Now, IMF reserve transposition, it is worth around $4.8 billion and it functions as an emergency credit line with the IMF itself. Now, these were the minor components. There are two major components, which I've already told you. Now, in the major component, the real strength of the reserves is the foreign currency assets, which are valued at humongous $556 billion. Now, these are the primary tools for RBI to manage currency volatility in our country. And they're the most liquid and usable component of all. And then comes the gold holdings, which are valued at around $131 billion, and they act as a long-term store of a value for our country. Now, they're not easily deployable for routine currency defense, while total reserves in totality, while it appears very large, foreign currency assets are the most relevant measures of RBI's ability to defend the rupee in short term. Because as we see in the major and minor components, it's the foreign currency assets which are the most humongous and the most important, the most relevant. Even though it requires further adjustment as well. Now let us understand the dual strategy of RBI for defending the Indian rupee. See, the RBI can stop the rupee from falling in two different ways. First of all, RBI uses a balanced approach, we should know this, combining spot and forward interventions to stabilize the rupee while managing liquidity and interest rate pressures in the domestic market. Now we'll understand the spot and forward interventions and what is spot market, what is forward market in this particular video itself. See, first of all, let's understand about spot market intervention. See, the RBI sells foreign exchange in the spot market, immediately reducing foreign exchange reserves and supporting the rupee. Now, what is spot market? We'll see later. Now, let us understand what will be the impact of RBI selling foreign exchange in the spot market. See, it strengthens or stabilizes the rupee immediately. It reduces rupee liquidity in the system and it leads to higher domestic interest rates as well. Now, this is a spot market intervention. Second one is the forward market intervention, where again the RBI sells foreign exchange in the forward market, agreeing to deliver dollars at a future date rather than immediately. Now, what will be the impact of this? It helps defend the rupee without immediate reserve depletion. It avoids tightening of rupee liquidity and it prevents upward pressure on interest rates as well. Now, since we have understood what the news is all about, what are the foreign exchange reserves, what is spot market intervention, what is forward market intervention, let us try to see the adjusted reality and how is it raising concerns. Now, although headline says that foreign exchange assets, they are appearing strong, but RBI has a net forward sales of $68 billion as of January reduces effective reserves to below $500 billion. Now, with continued rupee pressure, this gap may have widened further. And several analysts in our country, they are warning that reserve adequacy measured by import cover is nearing 2013 BOP stress levels. And it is again raising concerns about external vulnerability of our country. And while we understand this, we should know about RBI's dilemma as well. RBI's dilemma is either to defend the rupee or preserve foreign exchange reserves. Despite selling $94 billion in foreign exchange reserves since October 2024, the rupee has further weakened sharply. Even though RBI has sold so much foreign exchange reserves, rupee has weakened. It highlights limits of intervention amid global pressures and capital outflows. Even though RBI can intervene, but there are limitations to that intervention as well. And several analysts now they're warning that rupee could fall to 97 to 98 per dollar. And if these conditions, they keep on persisting. Now, since what is happening in the world with respect to rising oil prices and investors exiting our country, it is increasing the import bill of our country. And economists are suggesting that RBI may need to allow a controlled depreciation to conserve reserves during a prolonged crisis, which is happening right now. And if it doesn't take place, India might foresee a crisis which is a like 2013 BOP pressure which we saw. Now, since we have understood all these things, let us clarify a few terms which we already discussed. And to understand these terms, let us discuss about the types of foreign exchange markets in our country. So the first market, which I talked about initially as well, was spot market. Now, what happens in the spot market? Understand it very simply. See, in the spot market, transactions involving currency pairs, they occur, and it happens very promptly without any hitch. Now, these transactions, they need rapid payment at that particular rate which is present at that point of time, which is spot rate, which is the current exchange rate. And traders in the spot market are not susceptible to market uncertainty, which might cause a price difference between the agreement and the trade to increase or drop. Which means the spot market is a market where transactions takes place at spot market rate, that is the rate which is current rate present at that particular moment where the agreement is being made. That is the spot market, and that is spot market transaction. Now let's talk about the second market, which is futures market. Now in futures market, transactions need payment and distribution in the future at a previously agreed upon exchange rate, which is referred to as future rate. In spot market, the current rate is taken into account in the transaction, the current rate which is taking place, the current rate which is present at that moment. But in future market, there is a future rate which is previously agreed upon exchange rate. And in this, the transaction of agreement is more formal in nature and guaranteeing that the transactions conditions are set in stone and cannot be altered. That's your future market. Now in this market, the traders who handle majority of the transactions, they earn stable return on their investments. The reason is because they are standardized in terms of date, features and size, and these contracts cannot be negotiated as well. So that's for your spot market. In future market, these cannot be updated, cannot be modified, but in forward market, they can be modified and updated when needed. And the forward market, it is having definitely more flexibility than the futures market. That's the only difference between a futures market and a forwards market. Now there is another market, the fourth one, which we call as a swap market. Now when two investors, they borrow and lend two distinct types of currencies at the same point of time, this is known as a swap transaction. Now, in this particular scenario, one investor borrows a currency and pays the other in a different currency. The transaction is carried out so that they can pay off their debts without having to cope with the risk of a foreign exchange. And that's the fourth market, that is the swap market. Now, there is another market, fifth market as well, which is known as options market. Now, the investor in options market agrees on the currency of exchange from one denomination to another at a specified rate on a specific date in the options market. The investor has the option to convert the currency at a later time, but is not obligated to do so. And there are two options, that is call and put options, which are two types of options which are available. Now, what does put option do? A put option gives you the choice to sell, whereas a call option gives you the opportunity to buy. Now, these are some types of foreign exchange markets which are existing in our country, which are very relevant, very important for us to know about. Now, talking about the foreign exchange reserves, which we already discussed in great detail about, foreign exchange reserves in our country right now, they appear very strong. But the foreign pressures, the external pressures, especially the oil pressures and the investors, foreign investors leaving out our country, exiting our country, these are the two main pressures which are there putting pressures on our foreign exchange reserves and on our currency as well. And in order to stabilize our currency, we are selling our foreign exchange reserves. So there's a dilemma which is there in front of RBI that either to stabilize the currency or to preserve the foreign exchange reserves, because both are very, very important for us. Stabilizing the currency is also required for us to remain a stable economy, and having adequate foreign exchange reserve is also required, because the crisis in the world right now, it's nowhere going to end. It's nowhere near to end, which is why both these things are to be taken together by the RBI. A balance needs to be made, and what needs to be ensured is that the effective strategy of RBI is very well thought out and is very well planned out and helps the position of the country to improve in this particular scenario. I hope you gained a new perspective from this session. Do let me know what are your views surrounding this in the comment section. All the very best. Have a beautiful day. Thank you.